Michael, I want to look at the sum of the parts now, the cacophony that's out there, maybe to get beyond the debt ceiling. And let me just start as a center tendency. Can you acquire shares this morning? Do you want to, with your economic analysis, be in the market?
I think investors should be a bit cautious here, Tom. We have pretty high valuations in the equity market. The S&P 500 this year has been driven by a handful of mostly growth stocks with high valuations. So the S&P 500 Infotech Index is above 6 times sales, which prior to this cycle was only seen in 1999-2000. And even if you're looking at a forward PE for the infotech sector, 25 times isn't far away from the 28 times peak in 2021 that preceded a more than 30% collapse. And because interest rates are higher now, the 10-year Treasury yield, the stock to bond valuation metrics look even worse. So this is an environment, I think, where we're getting close to a recession. Obviously, you all have been talking about the debt ceiling shenanigans that are going on, and you have high stock market valuations at the same time. So in my mind here, it makes sense to be a bit more cautious.
People have been cautious for about a year, and they're getting very tired of being cautious. We keep hearing that. They're sick of waiting. They want to start investing. They have cash. They want to put it to work. How do you push back against this and say that's not enough of a technical driver, that's not enough of some sort of force to get stocks higher from here?
Yeah, I think it comes down to, are you being compensated to take that risk? And with the short end of the Treasury curve up at current levels, 5% plus, almost 6% recently on the 1-month T-bill, you're getting paid to wait. You're getting paid to be cautious. You're getting paid to hoard instead of spend or invest. And that's exactly what the Federal Reserve wants to do in order to vanquish inflation and reduce aggregate demand. And I think that is working, but the consequence could be a recession and a continuation of the equity bear market. It's been a very narrow market. If you just look at the S&P 500, it's done quite well this year, but it's, the breadth, the advanced decline line, if you look at that for the NASDAQ, record lows with valuations at quite high levels. It is just not a healthy development if you want to be a confident buyer of risk assets.